5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this Thursday. The AI boom takes a breather. Nvidia signals a growth slowdown with a tepid revenue forecast. The bulls don't budge. Stocks brush off those results after the S&P 500 notches another record high. And the world rebalances its trade map. Mexico plans tariffs on Chinese goods, and China and India grow closer. Brushing it off, that's indeed what this market is doing, despite Nvidia that saw sales growth that was only 50% instead of the peak of 200%. We are little changed on this equity market. You would have thought if I said to you, hey, the thing that's the biggest company in the S&P 500 in the world, the thing that we've pinned all of our hopes and dreams of an AI rally on, disappointed, that this would be worse. Sure, NASDAQ futures are down, but just by 0.05%. You can see at the bottom of your screen. Nvidia off by only 1.7%. Not that much drama. The small cap rally continues with some pace, up 0.75%. We have gotten a lot of curve steepening as of late. Yesterday, we saw the steepest curve since 2022. That takes a breather this morning. 2-year yields, little change to slightly higher. The 30-year yield finally makes a move lower, nearly 3 basis points, while your 10-year yield stands at 422.07. Let's look at some of the stocks moving this morning, including Nvidia. With that is Kriti Gupta. Hey, Kriti.
Hey, Danny. Nvidia, we thought there'd be a bigger move. A macro moment is what it was being called. This morning, shares in the pre-market only down about 1.7% for the earnings that came across. Still, 56% growth. That's pretty significant. But is that idea that maybe some of that AI momentum acceleration is slowing down? The A++ student may only just be an A+ student. Nevertheless, the share's down about 2%. We'll see how it shows up at the open. It's not the only one, though, that reported earnings in the last 24 hours. CrowdStrike also is going to be high up on that list. And this is going to be a key one, given how much of the customer attrition they've really had, given that outage from last year. Those shares down about 3%. The earnings not looking good there. HP is the last tech stock we're going to keep an eye on this morning, Danny. And HP is going to be an earnings story that did actually come in line with expectations. So what's the problem? Why is it down about 2%? There's some concerns around the tariff read-through, some concerns, especially when it comes to that computer business, whether or not the geopolitics bleed into their bottom line, Danny.
Kriti, really appreciate it. We'll catch up with you later in the hour. And in this hour, in just moments, we'll speak with Jordan Rochester of Mizuho on his latest Fed call. Later in the hour, Katrina Dudley of Franklin Templeton will join us as stocks hit an all-time high. Plus, we'll recap Nvidia results with Frank Lee of HSBC. But first, let's shift our focus to the Fed. Jordan Rochester of Mizuho Bank weighs in on the market's view on policy easing and writes, September's pricing at 21 basis points for a cut shows a market still aware of another non-farm payrolls and CPI that could make the event more of a 50-50 probability. Despite the dovish tone of Chair Powell's speech last week, I'm pleased to say that Jordan joins us now. He's head of FICC strategy at Mizuho. Jordan, I know before the Jackson Hole speech, you had assumed that this was a Fed that would be on hold for 2025. Have you changed that opinion given Jackson Hole and given the politics of the moment?
Well, that view is, of course, our U.S. economist Steve Rasciuto is being reflected there, and he hasn't changed his view. He still thinks that CPI and NFP could come in stronger than expected to allow this Fed to not cut in September, making October and December the crucial moments. But I will say, Danny, the better trades to express this sort of view, rather than taking an outright view on whether they cut or not, is to do flatteners in the front end. So they may or may not cut this year, but I think the clear trade for markets is they will cut more next year when Trump has had his way, removing Fed governors where he can and installing the new Fed chair. So what we're seeing in the curve is the Z6 pricing for SOFR next year is already slightly below 3%. That is the long run dot for the Fed. And I think that we could start seeing that push towards 275. So you might disagree on the very front end. It might be the case they do cut in September. I think if CPI and NFP don't come in strong, that perhaps they actually do go in that meeting, because there are 2 cuts in the dots already for this year, so why not at the meeting where they update their forecast? But when we get to how to express that in trades, we can do a high conviction trade that deals with that uncertainty in the front end and focuses more about for next year.
Just on the 2 pieces of data that we're going to be getting, Jordan, next month, how big of a risk event are they for markets? Or are they less so with the Jay Powell, who has clearly made a shift to the dovish side and opened the door for a September cut? What is the bar to have the data upset some of the pricing that's in this front end of the curve at the moment?
He's raised the bar. in terms of what would make him not cut. So you need NFP, for example, to come in much stronger than 100K. What you've seen is the Fed has informally lowered their assumption of the natural run rate of what level of NFP keeps unemployment unchanged. And we're getting numbers around 70 to 80K from a few speakers. When it comes to the previous assumption, it used to be around 90 to 100. So even if you get 70 to 80, perhaps the unemployment rate doesn't move and the Fed doesn't need to cut, is what that would argue. So if we got a number, let's say 150 or higher in NFP, and let's say we even got positive revisions to last month, which was around the 70 figure. Maybe that's enough to move the pricing from the 21, 22 it is now down to 15. How do we get to zero? It's if you have CPI pick up even more. What surprised me about the CPI figures was we're all looking at, is there a tariff impact? Is there a tariff impact? But actually what we're seeing in the data is very little of that, but the services have been much stronger. And services are something that raises your underlying inflation sort of forecast assumption. So if we have another month of solid services after 3 months in a row, that might be, combined with a healthy NFP, enough to lead to September, leading to a no cut. But I've got to say, the bar's high.
Jordan, further out on this curve, we've seen a 10-year yield that's fallen about 15 basis points so far this month, 2 consecutive weeks of moving lower. At the same time, inflation expectations have shot up. 2-year forward inflation swaps are now trading around the highest since 2022, when we had inflation at 6% and the Fed was engaging on a rate hiking cycle. What do you make of that disconnect?
There is a bit of a disconnect, but it's also what's just happening in the front end, bleeding through to the long end. It's been a summer of carry for most as well. We're now coming up to September, where in Europe we're expecting a lot of issuance. In the US, it's a similar story. So I think what we could see is the curve steepens even more. But it's a very crowded trade. It's one of the trades that a lot of people have had on for quite some time, looking at 2s, 10s, or 5s, 30s. So yes, I think the curve will steepen, but it probably won't be as rock and roll as folks would like. It's been a little bit more range bound than they would like. Disappointment for the curve, just like it was for Man United versus Grimsby yesterday, you could argue. But from here onwards, what we do expect is that the US 10-year, it's actually not something you want to own. It's something that we think that even could sell off. We look at Steve's forecast, up to 5% on the 10-year by year end. I think that's a bit extreme, but we could be looking at those levels next year if the consumer rebounds in the US, thanks to all these Fed cuts we've had, US equities at the highs, loose financial conditions. Combine that, it's a scenario where you don't have a recession, and it's not clear why the duration should really outperform.
Jordan, you just had to get that dig in there about Man United, didn't you? It was a humiliating loss for them yesterday. Okay, so given all of that, what is priced into the long end right now? To your point, it's a crowded trade. People are diving into those steepeners. From politics to inflation to deficit, what exactly is it capturing?
It's capturing the monetary policy expectations. The end result is the market thinks that Trump's going to create a more dovish set of Fed governors, and therefore rates will be held more easier than they should be. If you look at all these Taylor rules and all these various functions, the Fed is already perhaps even easier than they should be on most of those estimates. So what does that mean for the long end? Well, it's usually you'd say that term premium should pick up and therefore the curve should steepen. We think it will, but because the front end is rallying so much, it's dragging down the long end with it. It's the crux of the argument is, where do you think monetary policy will go? But if you've got views on term premium like we do, the curve view kicks in. But as I said, the Fed is going to cut rates if we don't have strong data. The market view is that they're going to cut rates even more next year because of a new Fed chair. But then when we get into 2027 and beyond, I can see the market start to think that actually they've cut rates to 3% or lower in terms of where the market's pricing it, and the curve should start to steepen from there.
All right, Jordan, thank you so much for joining this morning. It is a pleasure to catch up with you. It's been way too long. Jordan Rochester of Mizuho. Now let's get you some other top stories that are trending on the terminal this morning. Pernod Ricard is bouncing back, delivering a sales beat in the second half of its new financial year. The cognac maker expects the resumption of duty-free sales to China to boost its second quarter. Pernod expects overall sales to improve towards the second half. And Japanese trading houses got a vote of confidence from Warren Buffett's Berkshire Hathaway. Berkshire raised stakes in both Mitsubishi and Mitsui, boosting shares. Buffett's company has holdings in Japan's 5 biggest trading firms, a move that's expected to offer support to the broader Tokyo stock market. And North Korean leader Kim Jong-un plans to attend China's military parade on September 3rd alongside Russian President Vladimir Putin. His attendance of China's 80th anniversary celebration of the end of World War II was confirmed by Chinese and North Korean media. Coming up, a tepid outlook coming from Nvidia. We're going to recap the chip maker's earnings, down 1.5% in the pre-market. That's coming up next on your brief.
The opportunity ahead is immense. Blackwell and Rubin AI factory platforms will be scaling into the $3 to $4 trillion global AI factory build-out through the end of the decade.
Nvidia CEO Jensen Huang speaking on the call after giving a mild forecast that signaled slowing growth after a 2-year boom in AI. Let's get more from Bloomberg's Mark Bergen. I mean, Mark, slowing to something like 50%, but at the peak it was 200%. What was your takeaway from the results after the bell yesterday?
Yeah, I think there's a couple of different ways to read this. One is it is slowing from what is phenomenal and maybe unsustainable growth, right? We had this period of just this major quarter posting these great records, now the most valuable company in the world. And we're seeing a slowdown that might be a reflection of a couple of things. There's these supply constraints. Nvidia designs its chips, but they rely on Taiwan to produce a lot of them. There's obviously all these political uncertainties around China, whether or not they can actually sell into China, if they're going to have to pay this 15% cut to the U.S. government. Then there is the concern about that this is, even people like Sam Altman at OpenAI have used the term AI bubble, that perhaps some of the aggressive expectations we've seen and rosy forecasts around AI are not actually, companies aren't actually spending as much, which means that there's potential for a real sustainable slowdown.
Mark, elsewhere, the other thing that we were all looking for was the politics of the moment and how Jensen Huang and Nvidia would address this. They talked about that 15% revenue share with the U.S., and then it hasn't been codified. What did you make of that?
I thought those were really fascinating comments from the company's CFO, basically saying, listen, we're happy to pay this 15%. We just need to know when and how. And I think she also said, we're going to we have the license and we'll plan to sell into China. They're also waiting, and they talked about in the call yesterday, for the government to approve the sale of its more advanced chips into China. The U.S. government has sort of signaled that they're willing to do that. And the notion of the company is we're waiting on the government now. The ball's in their court.
The ball is in their court, but just going forward, they obviously didn't include H20 chips in their current outlook that they gave. Did they give any sort of sense of when that comes back, when they're able to sell more to China?
From what I understand, I think they're still waiting on the timing. It didn't give a lot of clarity on that. I think that was sort of certainly an investor concern, although this is something where they are going in with AMD, which is their chief rival in China. It is a big market. I think the question here is how much demand there's going to be in China, or how much a lot of companies in China have turned to local alternatives to Nvidia.
Mark, if you had said that a $4 trillion company that we'd pinned all of our hopes and dreams on would have given a slightly disappointing outlook, you would assume that Nvidia would be much off more than it is now. It's a stock that swung a lot around its earnings. It's down 1.5%, and it's not even dragging the broader market down with it. Has something changed in terms of Nvidia's importance? What does it say that it's not having a bigger market impact?
Well, it's certainly changed in terms of its geopolitical importance. I mean, I think we've done a lot of good reporting around just how big they are in this AI accelerator market for data center chips. I think the market share is somewhere in the 90 to 95% range, just how dominant they are. I mean, we've seen a slowdown in their data center business, and that is reliant on just a handful of these big cloud companies. But their gaming business or automotive business, those are still, I think beat analyst expectations there. I think there's, we saw the talk of the front of the call from Jensen Huang that he sees this as a multi-trillion-dollar opportunity. And so if investors are going along for the ride, I think that's probably why we haven't seen this major swing.
Yeah, fair enough. Mark, thank you very much for that update. We appreciate your time. That is Bloomberg's Mark Bergen. Coming up, U.S. demands push Mexico to raise tariffs on China. We're going to have your trade update and what else is making headlines with your front page news. All that coming up next on The Brief. You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning. What's making headlines on the major publications? First up, the Washington Post has this on their front page. The White House firing CDC Director Susan Monterez. The dismissal happened after she refused to resign amid pressure to change vaccine policy. Monterez's lawyers accused Health Secretary Robert Kennedy Jr. of, quote, weaponizing public health. Next up, the Financial Times has this, reports that hedge funds binging on insurance is threatening catastrophe cover. A board member at insurance giant Munich Re is sounding the alarm that private investors are threatening to destabilize the centuries-old sector. And the Wall Street Journal reporting on another firing by President Trump, this time Robert Primus, a board member of the railroad regulator that is weighing the proposed mega merger between Union Pacific and Norfolk Southern, has been dismissed by Trump after being the only member to oppose the deal. And on the Bloomberg, sources say that Mexico is planning to raise levies on Chinese goods. That's after a long-standing demand from President Trump. Let's get straight to Brendan Murray, who tracks global trade coverage for us. Brendan, what is the change here that Mexico is undertaking?
Well, Mexico, more than most other major U.S. trading partners, has really played this game well against President Trump, and they've been rewarded by it by not getting hit with some of the tariffs that Canada has and some of the higher ones that some of the Asian economies have. What Mexico is preparing to do is to put higher tariffs on Chinese imports as a way to sort of close off what Washington officials see as a backdoor into the U.S. market. So as the U.S. raises its tariffs against Chinese goods, they've got to flow to other places, and many of them are going to Mexico. We're talking about cars and machinery and the kinds of things that the U.S. and Mexico don't want to be flooded with. So Mexico is positioning itself here. Really, the longer game is to position themselves in a good way heading into the renegotiation of the USMCA, the free trade agreement between Canada, the U.S., and Mexico. Those discussions are going to kick off in the coming weeks and months.
Is a Trump administration that's tried to get rid of things like transshipment or at least tariff them higher? It speaks to that moment, Brendan. But how much friction does this introduce in the global trade system if it's not just coming from the U.S., but coming from other countries as well?
Yeah, it's the delicate balancing act that countries like Mexico have to play when they're choosing between wanting to have a favorable trade relationship with China and one with the U.S. President Trump has made it very clear that he would like his allies' help with de-risking supply chains from China to the rest of the world, and Mexico is taking a step in that direction with its proposed budget we're reporting today.
Brendan, elsewhere, India's been in the tariff firing line this week after getting officially 50% tariffs from the White House. The White House Special Counselor for Trade and Manufacturing, Peter Navarro, spoke to Bloomberg TV yesterday. Let's just take a listen to that.
Everybody in America loses because of what India is doing. The consumers and businesses and everything lose, and workers lose because India's high tariffs cost us jobs and factories and income and higher wages. And then the taxpayers lose because we got to fund Modi's war.
So you have the U.S. continuing to hit out against India, and we're seeing India seemingly strengthen its trade relations with China. What's going on, Brendan?
Yeah, exactly. So the U.S.-India economic relationship took this ominous turn this week with the doubling of tariffs to 50%. That's going to hit exporters under President Modi very hard. And what President Trump has actually done is turn India more toward China to try to repair some of those strained tensions that they've had involving border security and those sorts of things. President Modi is traveling to China in coming days for the first time in 7 years. And so whereas the U.S. used to try to drive a wedge between China and India and try to spark their economic rivalry to the U.S.'s benefit, the opposite is happening. India and China are looking at each other going, we're both getting stung by Trump's trade policies, tariffs, and those sorts of things, and at least on the surface are trying to make it look like they're going to repair those ties.
All right, Brendan, thank you very much for your coverage this morning. We always appreciate it. Bloomberg's Brendan Murray. A quick check on commodities this morning, because you do see oil markets moving lower by just over 0.5%. All of that happening, again, is the U.S. berating India, but it's also the surplus concerns that are really starting to flare again. NYMEX crude, that's down 0.6%. Coming up, another stock market record high. Despite maybe some disappointment from Nvidia, we're still moving higher in the futures session. We'll speak with Katrina Dudley of Franklin Templeton. That's coming up next. You're watching Bloomberg Brief. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. An AI boom takes a breather. Nvidia signals a growth slowdown with a tepid revenue forecast. But the bulls don't budge. Stocks brush off those results after the S&P 500 notched another record high. And the world rebalances its trade map. Mexico plans tariffs on Chinese goods. China and India grow closer. So another record high for this equity index, but we are little changed this morning, despite doubts circling in the background, despite concerns about Fed independence, despite Nvidia, which the results showing explosive growth, at the very least decelerating. You can see that at the bottom of your screen, down 1.6%. Small caps, those traded closed yesterday at an 8-month high. The small cap rally continues in earnest this morning. Meanwhile, it has been more steepeners. Jordan Rochester of Mizuho saying that is a crowded trade. It also takes a breather this morning. Your 2-year yield moves higher by a basis point, with a 30-year down a basis point at 490. 10-year yield stand at 423.04. Let's look at some of the stocks moving this morning, including the big one, Nvidia. With that is Critty. Hey, Critty.
Hey, Danny. Yeah, the big one down about 1.7%. You would think with those fears around AI, there would be a bigger move. And actually, this is less than what I brought you just 30 minutes ago. So certainly pairings a little bit of those losses. The idea here simply being that they're pulling down on some of the data revenue spend, not seeing that explosive growth, but still 56% in terms of last quarter sales growth. Not too bad of a number to scoff at. We'll see if this sustains into the open. Not the only tech earnings, though, in the last 24 hours. CrowdStrike, of course, getting lots of attention as well. This, of course, the company had the major outage last year, and customer attrition has been a problem. That's something that they really underscored when it came to their earnings report, down about 3.2% in the pre-market. I'll leave you with one last tech earnings story. HP coming out with their numbers as well after the bell yesterday, in line with expectations. The numbers looked fine. It's their forward guidance that was a little bit concerning. The idea of geopolitics, tariffs really eating into their bottom line. That's what's weighing on those shares this morning, Danny.
Critty, excellent roundup. Thank you very much for that. Some of the stocks to watch this morning with Critty Gupta. Now, Katrina Dudley of Franklin Templeton weighs in on this equity market, writing, the U.S. market has consolidated after a strong run, but breadth is improving. Small and mid caps, along with equal weight S&P 500, are outperforming or keeping pace with the Mag 7. Historically, such rotations signal more durable market leadership and sustained equity gains. I'm pleased to say that Katrina joins us now. She's senior investment strategist at Franklin Templeton. Katrina, great to see you. Thanks for coming in this morning.
Great having me. Thank you.
It feels like that trade got another boost today, with maybe a little bit of disappointment from Nvidia and small caps outperforming. So how sustainable is it?
I think what we're looking at is the breadth of the market. It is not the Mag 7 that are doing all the heavy lifting that they were doing over the last few years. We've actually seen the market cap weighted S&P perform about in line with the overall S&P, and that's good news because it means that there's more stocks to focus on. It means that there's more stocks to generate earnings growth, and when there's more earnings growth, valuations will be supported because ultimately, at the end of the the day, it's earnings growth that drives markets. It's not valuation.
And we saw that. It was a strong earnings season, given I think something like 44% of companies upgraded their outlook. But in the background, there's this real macro nervousness, let's say, this stress. Is there a disconnect between the two?
I feel that, I was listening to the opening narrative. It's so easy to point to those negative data points. And look, I've always been in that glass half full camp. I have to admit that kind of optimism has been something that, has pervaded my career. But if I take a look, unemployment rates are very, very low. If I have a look at the stock market buybacks, we're at $1 trillion of announced buybacks already. We've got there in the fastest time ever. And I have a look at that type of underlying market support. And if I pair that with good earnings growth that is supported by a good, strong economy, I do think that there's a lot of good news out there. And good news is supportive of where the market is today.
Can we just linger on the small caps for a moment? Because I had Lori Calvasine of RBC on yesterday, who said, yes, there's a short-term boost to small caps, expectation for cuts, but the index itself, the quality isn't as good. And so that boost can only last for so long. So how overweight do you want to be on small caps if it is maybe just some of the rate story lifting it up for now?
I always wonder when people say, what is a quality small cap and what's a less quality small cap? So you're looking at small caps, you want to look at where you're buying things, and that's where active management really comes into play. So what we've been advocating for is companies with low leverage. So even though we expect interest rate cuts, you don't have any interest rate uncertainty, and they've also got a balance sheet that they can invest behind. And I think that that's very important. And then you're looking for companies which have got good returns on capital. So I think if you were to pair that, you can probably get to Lori's quality, but I'm not necessarily in the camp that needs to be, an investment strategy of being long quality and short not so quality. I think in the small cap land, that type of recipe for success is always a good one.
What do you make of the fact that we had Nvidia tepid, and I feel like in the past when we would have said tepid, Nvidia would have come crashing down to earth, dragging everything along with it. It's an incredibly calm market this morning. What do you make of it?
I think part of it is the fact that there's zero China sales in that forecast number. So I think, and if I take a look at the range, it actually did meet expectations, but, some of the analysts were at that, much, much higher $60 billion range. So I think it was a little bit of missing some fairly optimistic forecast, number one. Number two, they did give you some type of glimmer of hope, but if they do come to some type of settlement with the administration over sales to China, that is additional upside to the quarter. So I think that's why the downdraft in the stock, and it was down, 3%, now just down over 1%. That's what explains that. The second thing is, I've grown up in a market where we're all trained to buy the dips, and I just wonder if this, the Nvidia's up so much, people are starting to really see the benefits of AI as it comes into their own workplace, and I just wonder how many people have been sitting on the sidelines and saying, this is just that opportunity.
I gotta say, it feels more than just Nvidia that's incredibly calm. It feels like this summer, for all the hecticness that has gone on, this summer has felt like a decade. I think we can all agree. But you get things like Trump firing a Fed governor, and the dollar barely moves, equities barely bulge. Yes, you get some curve steepening, but not huge moves in the Treasury market. What do you make of the fact that overall it feels like it's been a very calm market that's just traded in a range all summer?
Well, we had April. And let's just go back. We did have a lot of volatility in the market. We had such a downdraft. And you're right. One of the things when we were looking at April and saying, this is a time to buy equities, we were looking for an updraft in the market and an uptick. We just didn't think it would happen this quickly. And so that's been one of the things that has really surprised us, is the speed of the pace of that recovery. But I think when we looked at the tariff news, if you'd taken that negative news off the table, the underlying economy has continued to be strong. And that's, I think, is what is driving this market, number one. Number two, the gains are not just sitting in a small group of people that are over there in the corner. It's actually migrating down to the rest of Wall Street. And I think that that's why you have a lot of calm, because more people are sharing in the goods and the gains of this market. It's not just a few people off to the side.
But then again, it feels like this contrast again, where you have that conversation happening on one hand, and then on the other hand, you have the Fed turning more dovish, saying they're concerned about the labor market.
Yes, and part of the concern about the labour market is also due to this influx of new graduates that we've had. I've got a couple of them at home, and it's a tough job market. It has been a tough job market. Some of that is just a reflection of some of the uncertainty that comes from the earlier part of the year. We didn't set our hiring plans in August for August. We set them earlier in the year, and I think there was that level of uncertainty. And I expect now that we start to see some resolution, you'll start to see some additions to that graduate job market. So they'll come into the market, but just maybe on a delayed basis. And I think that that's part of what the Fed is kind of looking at, some of those numbers. And then the second part of it is we talk about the benefits from the AI boom. There is also another side to AI, which is some parts of the market will be dislocated. And I think that that's the other area where people are concerned.
So you're trying to get the little Dudleys out of the house, is what I'm hearing. You've graduated, go out there, find a job.
You know what? I think we all want our kids to be as successful as you have. And the fact is that AI, you and I were talking about it, the fact that people are concerned about losing critical thinking or losing ability. I actually think it actually gives us more capacity to do that. So I'm actually probably there in this camp that it takes away a lot of the drudgery work and actually gives our analysts, particularly with our investment teams, just so much time to do that critical thinking, to do those additional meetings that really make for a much more robust investment thesis. So I'm optimistic.
Yeah, not having to slog away writing code, making Excel spreadsheets, what have you. That is a nice future to see coming. Katrina, thank you so much for joining. So great to see you. That's Katrina Dudley of Franklin Templeton. Now let's get you some other stories that are trending on the terminal this morning. Pernod Ricard is bouncing back, delivering a sales beat in the second half of its new financial year. The cognac maker expects the resumption of duty-free sales to China to boost its second quarter. Pernod expects overall sales to improve towards the second half. And Japanese trading houses getting a vote of confidence from Warren Buffett's Berkshire Hathaway. Berkshire raised stakes in both Mitsubishi and Mitsui, boosting shares. Buffett's company has holdings in Japan's 5 biggest trading firms, a move that's boosted investor interest in the companies. And North Korean leader Kim Jong-un plans to attend China's military parade on September 3rd alongside Russian President Vladimir Putin. His attendance of China's 80th anniversary celebration of the end of World War II was confirmed by Chinese and North Korean media. Coming up, we dive deeper into Nvidia's results and what it means for AI spending with Frank Lee of HSBC. That's coming up next. Stay with us on your brief.
The opportunity ahead is immense. Blackwell and Rubin AI factory platforms will be scaling into the $3 to $4 trillion global AI factory build-out through the end of the decade.
Nvidia CEO Jensen Huang saying AI demand still strong after the chip maker signaled slowing growth with a tepid forecast. Joining us now is Frank Lee, Global Head of Tech Hardware and Semiconductor Research at HSBC, who has a $200 price target and a hold rating on Nvidia. Frank, let me just get your first take on the results yesterday.
Yeah, I think basically, in a word, we just didn't see a beat and raise. And it's actually been about almost 5 quarters since the last time we saw a significant beat and raise from an Nvidia. I mean, a narrative, I think, it's still largely very positive, but we just didn't quite see the, this beat and raise that the market's been looking for. I mean, I think, we have continued to see that demand is strong, but, the market's gotten so used to them, or hope to see for them to beat numbers, and they haven't. So I think that's been one of the reasons stock has continued to come off.
Does that change, Frank, or do we just accept this as the new normal?
I mean, part of it is the base is so much higher, right? I mean, for the company compared to 2 years ago. I do also think that the other thing that we see is that the market tends to run up, like we have seen the last couple of months ahead of this. And I think a large part of the Nvidia narrative has changed from, very more on company-specific things that they're doing for the first 2 years of the AI story, where their roadmap was constantly surprising the upside. They were seeing price increases. Now I think it's more of a function of how big is this AI GPU TAM going to be, and that's a bigger, I think, more macro narrative, and that's being dictated by the ongoing spend by hyperscalers.
So even if you have an addressable market, Frank, that is exploding because you have the spend by AI hyperscalers, what about on the supply side of things? What are still some of the supply chain mismatches that are holding Nvidia back, and how quickly could they be resolved?
Sure. So that's also a good point. I mean, one thing we have seen is that there has been a mismatch between how much Nvidia has been able to ship on a chip level and how much they've been able to assemble on the rack server level on the ODMs. And that gap has continued to persist. The yield rates have improved, but there's still somewhat of a gap there. And I think this most recent quarter, we've seen the finished good inventory also start to build up a bit. So I think that has kind of raised a bit of a red flag. We don't think it's a serious issue, but that gap still shows that, we're not going to see this gap narrow anytime quickly. I think a couple of months ago when people saw the yields improving, we thought there would be a much faster narrowing of this gap, but it still seems like it's still there.
Frank, just to go back to what you said about much of this depending on the hyperscalers, does that mean when we get earnings from the likes of Meta, Alphabet, and others, that those almost come more central to understanding where Nvidia goes from here versus Nvidia's earnings themselves?
Yeah, I think that's basically where we think the narrative starts to shift, right? If you look at next year, the outside of Meta, which has given an explicit target for next year's growth, which is more than 40% capex, we haven't seen an actual forecast for next year. So if you look at where most analysts are expecting for the capex spend, it's still about 15 to 20%. Ironically, that's where we were at the beginning of this year for this year's capex. But because over the last couple of months, that number has now risen to more than 50% for this year. So the question is, like, next year, do we see the capex spend continue to increase by another 40 to 50%? If so, then I think, we'll have an opportunity for Nvidia earnings to go up next year. I think basically, given there's no beat and raise, there wasn't much reason for analysts to take their numbers higher from where we are today.
Then there's the China of it all, Frank, with the CFO talking about starting to get licenses to ship to China. But the 15% revenue, which they're supposed to give to the U.S., hasn't been codified, and basically saying we can't really pay the U.S. until it does. Presumably, if President Trump sees that, he might not be so happy. Frank, how does it change things with that uncertainty over that 15%?
Yeah, I think it is unusual to see this kind of policy, but I think it's more than just that. I think the way we think about the China business has been very much a one-sided view where the U.S. would allow Nvidia to initially not to go into China, now allowed to go into China. But one thing we haven't really considered is how the China government's response has been, right? And I think, right now what we have started to see that there's been a little bit of a holding off from the Chinese CSPs to really place orders until there's better visibility. So it's not entirely a one-sided view where, okay, it depends on what the U.S. does. I think the China side also, I think the demand hasn't, in the near term at least, hasn't been as strong as expected. It could be temporary. It could be part of the overall trade negotiations that hasn't been finalized yet. But that does add an element of uncertainty, which I think we talked about probably in the last couple of weeks as well.
Yeah, Frank, it's such an excellent point, and I'm glad that you've continued to talk about this, because Beijing has been pushing for more homegrown AI chips and chip makers. Is a risk of displacement for Nvidia in the region real?
I don't think that risk of displacement is that significant in the near term. Ultimately, NVIDIA's solution, I think it's still the best out there. But we do see that, that sometimes the geopolitical side of it gets in the way in the near term. And I think this is what we're seeing now is, NVIDIA is not the only one that have talked a bit about this. AMD talked about in their last earnings call that, it's very difficult to get much clarity about exactly how big that China market's going to be for the rest of the year. So, but again, I think our focus is that what matters more is, that the upside opportunity from hyperscaler spending is probably going to be much more important than, the incremental upside we're seeing on the China market.
Well, just given that, Frank, given that the guidance didn't include the China revenue, and I understand, as you're saying, there's a lot of uncertainty, can you view the guidance maybe as conservative then for not including that piece?
Sure. I think they've also hinted that you would see an extra $2 to $5 billion in revenues if we include the China piece. But also, I think the thing to bear in mind is that, at the beginning of the year, NVIDIA had talked about potentially not missing out on $15 billion in revenues. I don't think we get the full add back of the $15 billion in the back half of the year. I think we'll get some of it back. But again, it does show you that perhaps the market size, is not perhaps as big as originally thought. And it's not because demand itself is poor, but just the fact that we do have some geopolitics that's caught in the middle of this.
Frank, thank you so much for joining us this morning with the latest on those Nvidia earnings. Frank Lee of HSBC with Nvidia shares down just under 2% in the pre-market. Let's stick with earnings, and we'll be getting more retailers reporting before the market open. That includes Best Buy, Dollar General, Victoria's Secret, among others, although shares are moving higher in the pre-market. Andrea Felstead of Bloomberg Opinion joins us now. And Andrea, you have companies there like Dollar General that maybe target more to the lower end of consumers. What have we learned this earnings season with how those types of companies are performing?
Well, the lower income consumer is still under pressure. That's been clear throughout all of the earnings season. We've seen Walmart do very good, maybe perhaps not as well as people were hoping, but it did do very well, and it's helping that it offers value, and those lower income consumers are really looking for value, although values, in demand right across the income spectrum.
What about things like food? There was J.M. Smucker yesterday that really is feeling the pressure on things like higher coffee costs, be it because of supply chain issues or tariffs on Brazil. What has that told us about where we stand with the consumer now?
The thing is, we haven't seen, right across the board, we haven't yet seen a lot of tariffs coming through. We're only getting sort of hints of where tariffs are coming through. We've got the worst to come, and that's as we get into the holiday season, we're going to see this standoff between companies trying to push tariff costs onto consumers and consumers pushing back. And consumers have been here before. They've learned a lot of habits from the pandemic, from that post-pandemic inflation, clubbing together, buying in bulk, buying private label, clipping coupons, all these things that consumers can do to manage their inflation.
To that point, Andrea, just how important is this upcoming period going to be with the holidays and understanding what the consumer is buying and how many of the price hikes they're willing to stomach?
This is going to, we're really going to find out who's going to eat tariffs. Companies, have been absorbing some of it, but they've been pushing some of it through, and there's going to be much more of that as we get into the holiday. The consumer has still been buying to some extent if it's been good value or if it's a very good product. So Ralph Lauren did very well because it's really been, although it's very premium, it's really been, improving its product, polishing its image. And so when there's a standout product, consumers are willing to buy. So you need to be very good value or just very good to win in this holiday season.
Well said, Andrea. Thank you so much for joining us. Andrea Felstead of Bloomberg Opinion. And you're watching Bloomberg Brief. Let's get you set up for your trading day on this Thursday. We're going to get earnings before the bell. Those include Best Buy, Dollar General, Dick's Sporting Goods, among other retailers. 8:30 a.m. Eastern, we're going to get jobless claims, core PCE, and a revised GDP. And Dell's results are expected after the market close. Some individual movers, Nvidia extending those declines, but I should say the post-market declines are worse than the pre-market. It was down almost 3%, now down just about 2% on that tepid forecast. CrowdStrike, those shares down 3.4%. The results raising questions about their growth. They also missed their forecast estimates. Finally, Snowflake, those shares up 14%. They posted strong results after the bell and boosted guidance. All right, that's it for Bloomberg Brief. Surveillance takes things from here.